Welcome. Today we dive into the easiest moving average strategy you can use in any market, whether it's stocks, crypto, or Forex. You will learn what a moving average is, why the golden cross screams uptrend, and why the death cross warns downtrend. By the end, you will know exact entry signals, exit rules, and risk control so that you never feel lost again. Why simple works. Markets look complicated, but price either trends up, trends down, or chops sideways. Moving averages filter out that noisy chop and show the true path of price. When the faster line crosses the slower line, something big often follows. That is the entire idea behind today's lesson. Moving average defined. A moving average is just the average closing price over a fixed number of candles. It smooths price so you stop reacting to every tiny wiggle. Types. The two common versions are the simple moving average, SMA, and the exponential moving average, EMA. The SMA treats every candle equally. The EMA gives extra weight to the most recent candles, so it hugs price more tightly. Why 50 and 200? Most traders watch the 50 period and the 200 period. On a daily chart, that means 50 days of data versus 200 days. The 50 reacts quickly, the 200 reacts slowly. Their crossover becomes the golden cross or the death cross. Golden cross summary. The golden cross happens when the 50 period EMA rises up through the 200 period EMA. It suggests buyers now control the long-term direction. Death cross summary. The death cross is the mirror opposite. The 50 period EMA sinks below the 200 period EMA, flashing that sellers have seized control. Time frames. Higher time frames give stronger signals. A daily chart golden cross matters more than one on a 15-minute chart because longer trends attract bigger money. How to spot a golden cross. Visual setup. Plot the 50 EMA in bright blue and the 200 EMA in red. Keep your chart clean, no extra indicators for now. Confirm the cross. Wait until the blue 50 EMA line has clearly crossed above the red 200 EMA line and both lines are visibly separated for at least one full candle close. Patience avoids false signals. Price position. Check that price itself is closing above both lines. If price is still below, the market may not be ready. Volume pulse. A surge in trading volume the moment the lines cross adds confidence. Big players often pile in during genuine trend shifts. Trading the golden cross. Entry rule. Buy at the close of the candle that closes above both EMAs after the cross. Conservative traders wait for a tiny pullback to the 50 EMA and buy on a bullish bounce. Stop loss placement. Place a stop just below the most recent swing low or 5 ATRs below entry, whichever is tighter. This protects against whipsaws. Profit target 1. Aim for the last major resistance level. The market often pauses there, taking partial profit locks and gains. Profit target 2. Use a trailing stop. Move your stop to break even after price gains 1R, then follow the 50 EMA up, exiting only when price closes below it. Risk management. Never risk more than 1 or 2% of total account equity on a single trade. That single rule keeps you in the game long enough to let statistics work. Mindset tip. A golden cross is a marathon, not a sprint. Allow the trend time to breathe. Trying to double your account overnight usually sabotages the setup. How to spot a death cross. Visual setup. Same chart, same colors. Blue 50 EMA and red 200 EMA. Confirm the cross. Wait for a full candle close where the blue 50 EMA line is now clearly below the red 200 EMA. Price position. price should close beneath both lines. If price is still above, bears are not truly in control. Volume pulse, spike in selling volume validates the shift. Quiet crosses often fade back upward, so volume matters. Trading the death cross, entry rule, sell or short at the candle close that prints below both EMAs after the cross. A retest of the 50 EMA that fails is an even cleaner entry. Stop loss placement. Place stop just above the latest swing high or 5 ATRS above entry. This ceiling limits the damage if the market snaps back. Profit target 1. Cover part of the position at the next solid support level, maybe a previous range bottom or fib extension. Profit target 2. Trail the stop behind the 50 EMA as long as price stays below, hold the short. Exit when price finally closes above the 50 EMA. Risk management. Again, keep single trade risk around 1% of your equity. Protecting capital converts big drawdowns into small paper cuts. Mindset tip: bear markets fall faster than bull markets rise, but they are also more volatile. Expect wild bounces, stick to the plan. Avoiding false signals. Choppy markets, if the overall range is flat, crosses come fast but fail fast. Add one simple filter. Trade only when the slope of the 200 EMA tilts clearly in the trade direction. News events, earnings, FOMC meetings, and crypto fork announcements can spike price through EMAs temporarily. Check the calendar before entering. Multiple time frame check. If the daily chart prints a golden cross but the weekly is still in a firm downtrend, size down or skip. The higher time frame usually wins. Indicator combo. A simple RSI confirmation works. Trade golden crosses only when RSI is above 50. Trade death crosses only when RSI is below 50. Common mistakes and fixes. Mistake 1. Trading every cross. Blindly trading every signal burns you in sideways zones. Fix: filter by 200 EMA slope and rising or falling volume. Mistake 2. Oversizing. Risking 10% on one trade feels exciting until it blows the account. Fix: cap risk at 2% per idea. Mistake 3. Ignoring stop losses. Thinking you can watch it closely is a myth. Fix: pre-place stops in your platform before you walk away. Mistake 4. Emotional exits. Seeing a small red candle and bailing to early kills profitability. Fix: follow the trailing stop rule mechanically. Mistake 5. News chasing. Jumping in during a headline without chart confirmation invites whipsaw. Fix: wait for candles to close and volume to confirm. Enhancing the strategy, add a trend filter. Keep longs only when the 50 EMA is above the 200 on both the daily and 4-hour chart. Keep shorts only when below on both. Use price structure. Draw simple support and resistance boxes. Enter only when a cross lines up with a fresh break of structure. Confluence increases win rate. Combine with MACD. MACD crossing its zero line in the trade direction the same week amplifies conviction. Automate alerts. In TradingView, set an alert. Crossing condition EMA 50 crosses EMA to 100. The platform notifies you instantly, preventing late entries. Journal every trade. Screenshot before entry. Annotate why. Note the result. Over 20 trades. Your personal stats reveal if you need tweaks. Risk management blueprint. 1. Our framework. Decide a fixed monetary amount you are willing to lose per trade, say $100. Calculate position size so that the distance from entry to stop equals that $100 risk. Reward targeting. Aim for minimum to R on partial profit. That way you need only 40% win rate to stay profitable. Portfolio exposure. Never load more than 3 correlated positions at the same time. 3 SPX stocks all tank together on macro news. Scaling out. Taking 50% off at first target restores mental calm. You lock gains, then let the rest ride with house money. Keep it simple. The beauty of the golden and death cross lies in their simplicity. Too many indicators breed paralysis. Master one clean method first. Patience pays. Markets spend most time ranging, except sitting out. Capital preserved is capital ready for the next big move. Continuous learning. Markets evolve. Review trades weekly. Study where crosses failed and why. Adapt position size, not core logic.